Thank you all for joining our Q4 2018 investor call. Tony Shrian, Craig Banderson and Rainer Ort, our three portfolio managers are on the call, together with myself, Harry Wolfson. Tony Shrian will be hosting the call. He'll go through markets and some stock examples. I can please ask you to hold all your questions for the end of the call. Please can everyone mute their phones. And we will hand over to Tony now. Thank you, Tony.
Thanks a lot, Harry. And also, thanks a lot for everyone. Thanks a lot for taking time out of your busy schedules to dial into the call. I'll start with the market performances in the fourth quarter and then take you through the key macro and political developments of our main countries and noting our key exposures in those markets. We will then open up the floor to Q&A. The fourth quarter capped off a difficult year, and when you see how indices performed around the world, there really was nowhere to hide in the last 3 months of 2018. The S&P Africa was down, XSA, was down 14.1%. The MSCI Emerging Markets was down 7.9%. The MSCI World was down 13.7%. Nigeria was down 3.4%. Egypt down 11.3%. Kenya down 7.2%. And Zimbabwe was down 37% on an old mutual adjusted basis. So just moving on to one of our main markets, Nigeria. I'll kick off on the topical subject of the upcoming presidential elections set for the 16th of February, which is just over 2 weeks away. As we've mentioned previously, we are not facing a binary outcome between contrasting economic systems or major shifts in international alliances. Rather, we expect to see a continuation of economic diversification policies and constructive dialogue with various Western and financial institutions. There has been some mudslinging and sporadic outbreaks pre-election and some sporadic outbreaks of pre-election violence, but certainly nothing to cause any major concerns. In terms of macroeconomic data points, the data we have seen suggests the economy is progressing, albeit slowly towards a recovery. Q3 2018 GDP growth came in at 1.8%, with non-oil growth a bit more encouraging at 2.5%. FX reserves have stabilized around 43 billion from the slip back from the high 40s earlier in the year. Inflation is stable at just above 11%. On the positive front, initial agreement has been reached on raising the minimum wage, and banks' Q3 results showed signs we are at the end of the tightening of the credit cycle. The bad banks appear to have done their final major write-offs, while the quality banks, which we invest in, have been able to actually write back some of their previous provisions. I referred earlier to the continuation of economic policies, one of which has been pension reform. PenCom, the regulator, recently announced a micro-pension scheme to address the SME and vast informal sector. The scheme aims to ultimately capture 20 million people of the roughly 60 million addressable market, and this would increase total pension assets from just under $25 billion to close to $35 billion. This bodes well for long-term financing and the capital markets. Importantly, initiatives like this are part of long-term policy successes that have spanned multiple governments, elections, and presidents. One of the larger allocations in the fund is Stanbic IBTC, which is the leading asset manager and set to do very well from a growing domestic pension pool. Our other Nigerian bank exposure is Guaranty Trust Bank, the market leader, which has consistently adapted to its environment to deliver high returns to investors and is attractively valued after the sell-off. On the consumer side, our largest exposure is to Nigerian breweries, which, having struggled with irrational industry pricing and depressed consumer disposable income, looks very well positioned for a recovery in 2019. We also have positions in Unilever, Nestle, and Dangote Cement. Moving on to Egypt. The Egypt story is unfolding well after the devaluation and IMF reform program, which commenced towards the end of 2016. This last December, inflation was back down to 12%, after spikes in October and November from some select food items. The Central Bank of Egypt, MPC, met again in December and decided to keep all policy rates unchanged. One of the highlights of the MPC statement, however, was their decision to lower the inflation target by 400 basis points to 9% plus or minus 3% from 13% plus or minus 3%. This shows us that the CBE remains confident on the disinflation path and leaves room for a further easing of rates in 2019. Another statistic mentioned in the press release was that unemployment appears to have stabilized around 10% in the third calendar quarter of 2018. Part of the IMF reform program has been the phased removal of subsidies, particularly on fuel and electricity. This has really been a kind of an Achilles heel for inflation and for consumer disposable income. But we note that the upcoming round in July of subsidy removals should be the last, and if oil prices remain where they are, the effect should be less marked. So certainly the outlook looking very good for consumer disposable income and the Egyptian consumer companies. While subsidy removal has been difficult, the tangible and intangible benefits have been clear. The government spent 15% less on subsidies in the calendar second half of 2018, which can be directed towards productive expenditure and ease the domestic borrowing burden and take upward pressure off rates. Last but not least, it points to government and political stability to have been able to pull off such a feat, certainly such an unpopular move in the first place. So that has been well managed, and hasn't resulted in civil unrest or strikes, or there haven't been any major repercussions from those subsidy removals. Another positive piece of reform was a submission by the Investment Committee of the Social Insurance Fund, which is responsible for managing public pensions, to the Ministry of Finance, to raise the pension fund's allocation to the stock market to 5% from the current 2%. An interesting stat out now, which we think also is very positive for Egypt, is that they expect gas production coming from the Egyptian fields to rise to 8 billion cubic feet per day. That's up from a low in 2016 of 4 billion. Current country consumption is about 6.5 billion. So we estimate that towards the end of next year, Egypt could possibly turn a net gas exporter, which will obviously be very, very favorable for FX reserves and the trade balance. Our key fund allocation in Egypt is Commercial International Bank. Egypt has a surprisingly low bank account penetration. The opportunity for retail customer acquisition and low-cost deposit mobilization creates a long runway of growth in the industry, with CIB well positioned to exploit this as the market leader. Increased credit demand from the private sector should see margin expansion from a low cost of funds and higher loan-related income. CIB's low overheads and excellent credit risk management should see these gains transmitted to higher returns to us as shareholders. An announcement on the tax treatment of T-bill income saw the share drop almost 20% back in December, so early December, late November. This actually should not have a material effect on earnings, if any, and we actually use the opportunity to rebalance the stock to weight. We also have exposure to healthcare through the market leader in diagnostics, IDH. Low penetration and healthcare reforms are enabling the business to grow patients by 10% and earnings by 30%. Scale benefits from their mega lab, entrenched market leadership, and sustainably healthy margins. A very measured approach to African expansion limits exposure while offering tremendous longer-term potential. And moving on to Kenya, it would be remiss of me not to mention the recent terror attacks in Kenya. While obviously negative, the local market took a silver lining view. That being that after the shambolic a response by the authorities to the Westgate Mall attack some years back. This time, the anti-terrorism unit's response was clinical and sent a reassuring message to the public, to investors, and certainly a warning to future perpetrators. Kenya had a particularly disappointing market performance in the fourth quarter. The drivers were disappointments in the finance bill, which maintained interest rate caps and imposed excise duty on mobile money and ATM transfers. Foreigners were net sellers ahead of an expected Kenya shilling weakness and concerns over the refinancing of the 2019 Eurobond. We think these fears are overdone for the following reasons. Banks and telcos have adapted to the duties and the rate caps. Key export industries such as tea, coffee, and tourism have performed well, with tea revenues up 10% for the season and tourism revenues up 31% for 2018. Coffee revenues have remained stable despite falling international coffee prices. That's because the quality of bean, the sort of very high quality bean that Kenya produces, prices for that grade have actually stayed stable and increased slightly. Our discussions with the IMF officials indicate that the Eurobond should be successfully refinanced in 2019. From a macro data perspective, the economy is growing at a very healthy clip of 6%, and inflation is being comfortably contained under 5%. Two of our largest fund allocations are in Kenya, Equity Bank and Safaricom. Both have used superior network infrastructure to acquire first-time users, build large customer bases with the basic industry service, like voice in Safaricom and basic banking at Equity Bank, and then overlaid these with low marginal cost, high innovative revenue streams. These revenue streams have generated earnings growth greater than inflation and contributed to returns substantially in excess to the cost of capital. Continued strong demand for data and non-cash transactions will drive Safaricom, and increased financial inclusion and fintech will drive Equity Bank. And moving on to Zimbabwe, it has been a particularly weak quarter for Zimbabwe, as the new government was confronted by an economic reality that caused them to make a number of unpopular decisions. The first was to split bank accounts into Nostro, or in brackets real USD, and RTGS, in brackets local USDE, with the bulk of Zimbabwean accounts being RTGS. This creation of two currencies was immediately interpreted as the precursor to some form of devaluation of cash, and precipitated a run on shares, particularly Old Mutual shares, which outpaced the market and negatively impacted the value of our Zimbabwe holdings. The second was the imposition of a 2% tax on money transfers. 95% of retail transactions are electronic in Zimbabwe, the highest in the region, with usage being accelerated by the cash shortages. And whilst we believe it was a good idea, especially when it comes to capturing the informal sector, 2% was too aggressive and too soon for the consumer. Such a sharp tax has negative consequences for inflation as well as real disposable incomes. Thirdly, and more recently, the government more than doubled fuel prices by increasing them from $1.43 per litre to $3.33 per litre. There was a strong reaction from the public with widespread civil unrest and stayaways. Unfortunately, the government's response has been heavy-handed, with the military stepping in to try and shut down protests. The impact on our Zimbabwe holdings has been negative, as the Old Mutual shares have rallied harder than the rest of the market. In our Africa funds, we effectively only had two holdings in Zimbabwe, that being Delta, the AB InBev-owned dominant beverages company, and Econet, the dominant player in the telco, fintech, and mobile money sector. Econet recently spun off its fintech and mobile money division called Cassava SmartTech. These companies have adapted exceptionally well to the challenges of Zimbabwe, and in some cases have even benefited from these challenges. Both companies are well-funded and highly cash flow generative. They have proven their ability to prosper despite Zimbabwe over and over again, as challenges force innovation and actually create higher barriers to entry to companies coming into the country in the future. I think it goes without saying that these companies will perform exceptionally well should there be any kind of recovery in the country. That concludes our sort of key country and market summary. With that, I'll hand it over to Harry for Q&A.
Thank you, Tony. That was extremely interesting. Before I open up to the floor, I've received a number of questions by email. So I'll ask each question in turn, Tony, let you answer each one as we go through them.
Thanks a lot, Harry.
So first question, overall, frontier market companies have been some of the most profitable companies worldwide measured on return on equity. Is this the case specifically for Africa? If yes, how do you explain that?
Thanks, Harry. I guess how we'd explain it first off is really the high market share and the sort of semi-monopoly that these companies have, and with that they obviously have a tremendous pricing power, which generates profitable revenue and obviously a high return on equity. If I can just use an example of the sort of African market share scenario. If you compare Vodafone UK to Safaricom, which is effectively Vodafone Kenya, you've got a substantial difference in number of players in the market and market share. So Safaricom has around 70% market share on average across its revenue streams. Vodafone UK has a market share in the low 20s. There are 3 operators in Kenya. The UK has, I think, at the last count now, 6 operators. So you can see Safaricom has substantially higher market share. I think another really important factor, possibly even more important, are the innovative or the multiple revenue streams that have come from innovation. These are revenue streams that are mostly at a low marginal cost, highly profitable, and feed through to that ROE that you were talking about. How do they establish the market share I've been talking about? It's Africa is geographically a large place. Covering the whole country with a network is extremely costly, extremely difficult. So it's really a first mover. It's a first mover advantage. And what you find is once you are the leader, that first mover advantage, self reinforces because you're the most profitable player, so you can reinvest in more network and cover more area and grow your market share even more. It also gives you excess cash, excess earnings to reinvest in innovation. So typically companies are able to actually reinforce that market share. Another factor, sort of as I've alluded to, is scale relative to spectrum acquisition. Spectrum is scarce. Most of the companies acquire the same amount of spectrum for the same absolute amount in dollars. Now, obviously, if you're a bigger player with more subscribers, the outlay or spectrum cost per customer for the larger operator is substantially less. So yeah, I'd say they maintain market share through scale, innovation, and those create and reinforce higher barriers to entry.
Thank you, Tony. The next question, the Imara Africa Fund. In the Imara Africa Fund, the financial sector is by far the largest, much larger than the weight to consumer names. How do you explain this, and do you think this will change?
Yeah, thanks for that, Harry. I think first off, that sort of financials classification is the sort of Bloomberg classification. We're actually looking at sort of reclassifying some of our financial exposure just to reflect what the companies are doing and the fact that they're not sort of just banks in the traditional sense. So a number of our banks, obviously Equity Bank, as previously mentioned, the driving force behind that is fintech. So we're starting to see them more of a fintech company than a traditional bank. Stanbic IBTC in Nigeria, which I mentioned earlier, our main sort of the main attractive part of that business is its pension or its asset management business that manages the growing pool of pension assets. So, if that is more of an asset manager to us than a bank. So if you start making those adjustments, the kind of bank's sort of exposure comes down, and then I guess even the bank's exposure will remain reasonably high, and that's because the banks are really attractive, and that's because financial inclusion in Africa is still low, and we see tremendous growth ahead, even in basic banking services.
Thanks, Tony. Next question, which I think you've partly answered on the call already. How would you assess the political situation in Africa? Tension in Zimbabwe, controversial elections in the Congo. What about in the other countries represented by your large weights, Kenya, Nigeria, Morocco, and Egypt?
Thanks, Harry. Yeah, I guess I've spoken to the Zimbabwe issue. Congo, we obviously don't invest in. There's not a stock exchange there, and we don't really see a sort of major or spillover into any of our major markets. In Kenya, there was obviously a post-election dispute. That was very sort of amicably resolved. There was the famous handshake, and politically the country has very definitely moved on. Obviously, with the elections being in the recent past, there's still a long time till the next election, and I think importantly, Uhuru is into his second term now, I think that will allow him to execute some of his policies, and we expect to see stability, political stability in Kenya. I sort of referred to political stability earlier in Egypt, so I won't dwell on that again. Nigeria, I talked about the upcoming elections. As I said, there's been mudslinging up till now. There has been sporadic outbreaks of pre-election violence, but I guess Nigeria is the big question mark, and certainly given its weighting across our funds, I'd say politically there's a question mark on Nigeria, but as I was at pains to highlight, that we don't expect major adjustments in economic policy.
Thanks, Tony. The last question by email. It seems that outflows from frontier market funds picked up in 2018. How much was Africa impacted? And second part, what about trading volumes?
In terms of outflows, we did, from speaking to brokers and just seeing how the markets were behaving, there certainly were, outflows, I guess, similar to frontier and emerging markets. It does tend to have a magnified effect in Africa, just because liquidity is lower than some of those other sort of more liquid emerging and frontier markets. And we find that even if company results are doing well and company fundamentals are doing well, when a large foreign fund wants to pull out their money, there tends to be a kind of asymmetric effect, and often these funds pulling out the money are not really price sensitive. They sort of simply have to get out, and the spreads on the stocks are quite wide, and if they sort of hit the bids, that tends to send the stocks down. That tends to send the stocks down quite quickly. What I would say though is, and that's why I spoke about pension reform, is we believe as the capital markets deepen, the domestic pension pool deepens, increasingly locals will be able to step into the breach, and you won't see these sort of same asymmetric trades and sort of negative impact on pricing that we see now. In terms of liquidity, liquidity is there, but with wider spreads,